Good morning. It is Friday, September 20th, and it's the day following a big stock market rally we had yesterday. Boy, it was fun to see stocks really fly. I was really impressed with how stocks, which include PayPal, Airbnb, really went up in value, as well as Bitcoin really rallied over the last couple of days. And Bitcoin is now continuing to go up. It's last time I checked, it was at $63,000 per coin. Overall, it was a great day. No ifs and buts about it. The Fed lowered its borrowing rate by 50 basis points on Wednesday afternoon. The market didn't know what to do on Wednesday. It actually closed down. It closed in the red on Wednesday night. And Thursday it got up, and we looked at an employment report that I was really keyed in on, because if the employment data came in negative, it would have been interesting to see what the market would have done. But the employment data was actually good. And the employment data showed that unemployment actually got a little bit better. So with that and a 50 basis point reduction, the market just rallied, and it was a sight to see. Stocks really flew up. The NASDAQ did quite well. The NASDAQ yesterday went up 2.51%. So if the interest rates are going to be lower, that means small caps are really going to do well. Technology stocks, growth stocks, stocks that really want to grow are going to really do well. So the Russell participated. The Russell was up 2.1%. S&P and Dow were up nicely, and the VIX is down. So overall, it was really good day. How does this kind of play out? It is a surprise to me that we're doing this well. It's September 20th. I'm in the green for my portfolio. I think the market's in the green. We look at the NASDAQ, and most certainly if we look at September, it is in the green by 1.7% on the NASDAQ. And that's a good place to be in September. September is supposed to be a bad month. Seasonally, stocks usually sell off in September and October. So if we make it out through September in the positive, it'll be a small surprise to me, and I'll take it. I'm not going to complain about stocks going up in value in my portfolio. I am thinking through, how do I invest going forward? One of the themes that I'm going to introduce as I look at stocks and really just look at the market is, what are the stocks that are going to do well in 2025? It's one thing to look at the market today and realize, hey, certain stocks are really moving. We're going to look at a few that are really moving. I see Mike's online and he wants to look at FedEx. That was one of the first ones I'm going to go into. Federal Express announced their earnings, and their stock's really moving to the downside. So we'll take a look at that. But what's important is, for me, is always trying to figure out what's really going to work 12 months down the road. What's going to work 24 months down the road? Because my intent is to buy when the buying is good, right? We could all see that yesterday certain stocks did great, but I'm trying to find stocks that are really priced well for me, and I can make a great return over the next couple of years. And right now might be a good time to look at some industries and look at some stocks that are being overseen, not looked at, really ignored, and might be a good buy today that are really going to work in the future. An example is, over the last couple of weeks, we were talking about oil companies, and people kept coming into the stream and saying, hey, what about oil? What about oil? Oil prices are down. It was a really good thought, because oil prices didn't stay down. They kind of rose. And if you bought into oil, you participated in a nice little rally over the last couple of weeks. It's nice to see that kind of play out. Well, what are other factors that are going to play out over the next 12 to 18 months? Excuse me. People have brought up material companies. Material companies, and excuse me for a second. Material companies might be an interesting place to look at. We're going to look at Rio a little later, but right now, I don't think there's a lot of interest in material companies. The economy is not currently firing on all 8 cylinders. Maybe something that happens 12 to 24 months from now. Commodity prices around steel and other commodities, not very high, but those will go high as the forecast for demand goes up. So that's an example of maybe where an investor might want to look at, because you buy now at a low price and then you participate in the rise. So as we look at stocks, I'm going to add that kind of question or discussion, which is, okay, this is what the stock's doing today. How's it going to do over the next 2 years? And hopefully you find that interesting. All right, so we are going to take a look at a few more things, and then we're going to get into some stocks. So the markets did great. The futures, where are we at? Futures are relatively flat. The Dow is in the green slightly, S&P in the red slightly, NASDAQ in the red slightly. Gold is going up. I see there's a question on gold. I'll get to that. Let's get to that now. So I think best of, what's the impact of rate cuts on gold? And gold is not like my strength, right? It's not where I spend a lot of my time. But I would just say that as interest rates go down and fixed income doesn't reward investors as well as it can, I think gold would probably be a good investment or a store of value, as you have very high stock prices, operate or being the reality. I think gold isn't a bad place. I'm not an investor in gold. I invest in Bitcoin. That's digital gold. We can have a conversation around that, but I'm holding my Bitcoin, and I nibbled on Bitcoin over the last, really over the last 9 months. I don't want my Bitcoin portfolio to get too big. I think over time, as I understand it better, it might get a little bigger, but it's done really well. I mean, Bitcoin overall has performed great, really good rate of return. It's been a store of value. It isn't exactly a hedge against the stock market. It's actually rallies with the NASDAQ and high growth stocks. Gold is a hedge. And for those who invest in gold, I understand why. I'm not a big investor in gold, but I'm more of a real estate investor. And I think real estate's kind of an overall, hedge on the stock market, so to speak. Sometimes the stock market is doing terribly and real estate's doing it just okay. Real estate tends to grow real slow or appreciate really slow. So that's my comment on gold. Crude oil is down slightly, but we're still in the 70s. That's good. And I wanted to look at interest rates. What's going on with interest rates? So the reason I'm looking at interest rates is obviously there's a lot of attention on stocks, and there should be. They're doing great. And now is a good time to buy bonds for me when nobody's looking, when nobody's appreciating them. Is there an opportunity to do so? I bought bonds this week. I bought bonds yesterday, and I bought bonds on Wednesday. And I'm now thinking, again, back to what's going to work in 12 months, what's going to work in 24 months. And I'm beginning to think that buying an ETF with a long bond portfolio might be a good idea. Lock in a 5% rate of return. And an ETF, what's really nice about ETFs is you can get in and out fairly easy. What's one of the drawbacks of individual bonds is getting in and out is not as easy as a bond, not as easy as a stock. An ETF resembles stocks. Getting in and out is fairly easy. So I'm going to be looking into long-term bond ETFs, not necessarily just treasury. I'm going to look at corporate as well, because corporate will pay better rate of return. Because I think the short-term rates are dropping, but if you follow the markets this week, long-term rates have been rising, And the expectation in the market is that down the road, 5, 10 years down the road, interest rates will be higher. And that's kind of common sense, right? We can go down for a period of time, maybe 3, 4, 5 years, but then over the course of time, those rates will go higher. So I'm going to look into that. I'm not going to jump in head first. I'm just going to be doing some homework there because, again, I'm thinking a little longer term, what's going to work in a year or 2 years. And the way I played bonds 2 years ago really played out nicely. I bought when rates were really climbing, which causes discounts on bonds. And I kept buying, and I bought during a period when interest rates were really high, and I got bond prices that were really low. As a result, as interest rates have fallen, the value of my bonds has really gone up. And that's kind of what I did 2 years ago was what's coming down the road. So I'm trying to see what's coming down the road to make investments today that are really going to pay off in a year or two. All right, so that's where we're at with interest rates. Let me catch up on comments, and then we're going to jump into FedEx. So best of, good to see you, Mike. Very good to see you. We are going to get into FedEx. And then Mike, you are describing my life for the last 18 months, constantly trying to find deals that were beaten down, future upside. Great. Yeah, I like interacting with traders like Trader Prad because I do learn a lot, and it gives me a sense of, how the other side of investing, in this case trading, is, right? He's trying to achieve a return that day, which is pretty interesting. And I think, a lesson for me, which is you don't really acknowledge a gain until you realize it. Now, the other end is I'm not investing to make a rate of return today or this month. And I've made a very good return year to date. I made a great return last year. 2022 was a tough year for everybody, including myself, but my fixed income did well that year. What I'm trying to figure out is how am I going to make 2025 a really winning year and 2026? So always trying to see, okay, what is going to be a good investment down the road? Because that's when most investors are not really looking at those investments. You can get an early entry into a very good position. So it's something that, I do, and I hope we can do together, bring the ideas of, hey, this is a stock that I think is going to do well in a year. It's maybe struggling a little bit right now because the economy is not good in that industry, but it's going to bounce back, and here are the reasons for it. All right, so our friends over at FedEx announced their earnings, and the market did not like them. The market has sold this stock off in the pre-market by 12.83%. That's a big reduction. And I took a look at this stock last night because I heard the news last night, and I'm like, man, that is a big drop. What's going on? So let's take a look at it together, and I'll give you my comments on FedEx. FedEx is a $73.5 billion market cap company. The revenue is a little above that at $87.5 billion. They are profitable. The trailing 12 months are profitable by $4 billion. PE seems pretty sensible at 18 for the current period and 14 for future PE. They pay I'm going to call it slightly low dividend. And analysts say that, hey, it's a buy and it's discounted by 4.7%. Not much of a discount, according to analysts. The reality for FedEx is we had some boom years during COVID, right? Everybody was trapped in their homes because we had to wait this virus out, and everybody got vaccinated and we got over COVID. Great. So we were buying all kinds of stuff online, and FedEx was delivering all kinds of stuff. And, we probably, as consumers, bought everything we needed for a while. It's like, we remodeled our kitchens. We did our backyard work. Our houses are probably nicely fixed up after COVID. And a lot of the deliveries happened during 2021 and 2022. So it kind of left an environment where there wasn't as much volume for FedEx to deal or work with, and their revenues have gone down as a result. And the revenues quarterly, the latest quarter that they just announced, revenue did go down slightly. So they are in a lull in their business, and kind of makes sense on where we are within the economic cycle or situation post COVID. There's another, I think, a big factor that's going to be a headwind against FedEx, and that's that Amazon is doing their own deliveries. And that's going to compete with FedEx, because as people buy on Amazon and they, say, hey, ship it to me, it might be Amazon that delivers the product. If that's the case, that's less volume for FedEx. I believe they also lost a contract with the U.S. Postal Service. That is a loss of a pretty substantial contract. So revenue is not very exciting for FedEx. What's going to happen in a year? What's going to happen in 2 years? I'm confident that FedEx is going to bounce back. It's a very quality business, but are they going to bounce back and have exciting revenue growth? I don't know. I don't see how yet. I don't know if somebody else knows that, but I'm not excited about their revenue. It's not like they're going to go from 0 growth to 5 or 10% growth. 5% would be quite healthy for them. 10% would be kind of a boom period, because they are in the logistics business and they're dealing with pretty consistent volumes. So from a revenue standpoint, I can understand why investors are feeling like, hey, this stock is it's going to be down for a while. Now, when we look at their profitability for the trailing 12 months, they are profitable. Looks good. Profitability did go down slightly. Not a big deal. Free cash flow is okay at $2.6 billion. It went down from 2024, the trailing 12 months. Best year they've had was 2021, and it's down from 4.2 billion to 2.6. Now, the free cash flow that this company produces compared to their market cap is really low. If you look at 2.6 billion, but their market cap is in the 70s, 78 billion, I believe. That's a pretty low free cash, 73 billion. That's a pretty low free cash flow rate. So at the cash flow that they're at, the best I can do is value this company at around $50 billion. And that's really being generous, because they're not really growing. And they have UPS as a competitor. They have Amazon as a competitor, because Amazon's vertically pretty much integrating their e-commerce to their supply chain. So this company seems a little overpriced, even where they're at after this 13% drop in their stock price. It's going to be hard for me to really warm up to it. Now, if we look at the stock historically, we look at the last 5 years, the stock has sold off. It was $150 stock, 2 years ago. And it really has done great. It's up 100% over 2 years. That's a great, great, great return. But I would point out that it's not out of the question that this stock could really go down. It could really kind of start coming down, because they don't have exciting revenue. Their profitability is not super impressive. It's just okay. It's a logistics company. There's not a lot of margin. The cost and expense, they have to employ a lot of people, a lot of trucks, a lot of capital. So their free cash flow isn't very high. So this stock here is, I don't own anything like FedEx. I don't own UPS. I don't own FedEx. I own Amazon. Amazon's very, very diversified and integrated in their business. And I'm probably going to stick to my Amazon stock, and I'm buying more Amazon On any kind of pullback, I just buy Amazon. I want to load up on Amazon. And FedEx is, I'm going to pass on FedEx. I'm not a stockholder. I don't think it's going to be a great investment for me in a year or in two. I think I'll wake up and maybe the stock price went down 30, 40, 50%. That's possible. And what stories would make the stock go up 20, 30%? I don't see them, but I see plenty of stories that could take the stock down. When we look at what 23 analysts cover the stock, that's a lot of analysts. And there's a little dissension between their ratings. You know, the most optimistic analyst is at 359, and these reports were issued out before their latest earnings, and these probably would be brought down to some extent. But the most optimistic one was like, hey, this stock could really work and go up to $359 a share. The most critical, pessimistic analyst says it can go down to 200. Right now, this analyst is probably looking like he probably knows what he's doing. The analysts basically look at earnings per share, which earnings per share look pretty good, and they're going to grow nicely over the next couple of years. So I give them that much, which is earnings per share is good. But the true value of a company is how much cash they generate, cash that ends up on the balance sheet, cash that ends up buying back shares, cash that ends up becoming, a war chest. Like our friends at Microsoft have a war chest of cash, and Google war chest of cash, and so forth. And they could expand their business, continue to invest in their business so that they can get greater revenue and still achieve the kind of margins they're looking for, that kind of thing. And FedEx is not that type of company. They're not making that much free cash flow. And it makes sense because they have to put so much back into their business in the form of all the equipment, trucks and vans and so forth that they have to invest in, maintain, and so forth. So for that reason, I think, FedEx is somebody else's investment, not mine. We get to pick from thousands of stocks, and I'd rather pick stocks that are in industries that are really profitable and generate great profits, great cash flows. They're growing, and they're going to just be worth so much more in 5 years. So that is FedEx. And Mike has a comment. They wanted the USPS contract gone. Okay. Got it. Yeah, so interesting changes over at FedEx. And it's a good business. It's just an industry and a type of business that I'd rather not invest in. All right, so let's move to, there's a stock symbol that a viewer wanted to look at, and that's ANET. Arista Networks. Oh, this ought to be interesting. Let's take a look at Arista Networks. Arista Networks engages in the development, marketing, and sales of data-driven client-to-cloud network solutions for data center campus routing environments in the Americas, Europe, Middle East, Africa, and the Asia Pacific. So these guys probably compete against Cisco and other networking companies. It's a pretty valuable company at $119 billion. The revenue is only $6.3 billion. So that's interesting. They are profitable, net income. See the profitability there? It's a very nice profitability. They're only $6.3 billion in revenue, but a lot of that money ends up being profit. PE is real high, 49. Holy smokies. What's the stock been doing? Stock's been really working. Holy smokes. 539% over the 5 years. Very impressive. Very impressive. Analysts say it's a buy, but you're kind of chasing this stock, and you'd probably be paying a premium to get into this stock. What is so exciting about these guys? Well, let's take a look at their revenue. Their revenue is growing. They're a $6.3 billion company looking at their trailing 12 months, and they're about a 20% revenue growth company. Now, 20%'s good, but not phenomenal. It's not like, wow, holy smokes, what a growth rate. 100% is that category, or 80%. 20% is very good. Now, let's look at the quarterly growth. We see quarter after quarter, the growth is coming down because the law of big numbers, right? It's harder to show a higher percentage growth as your revenue number continues to get bigger and bigger. It just gets harder to impress based on your revenue growth rate. So, okay, that's kind of natural, and they're kind of becoming bigger, more mature, and their revenue is not as impressive. All right, so we are there. It's about a 20% growth company. The cash flow, you can see this is a very good trend where cash flow has expanded over time. As they get bigger, have bigger scale, and they are a very profitable company, a lot of that cash flow ends up in their pockets on their balance sheet. So at 2.7 billion over the trailing 12 months, this company, I could get a valuation up to 75 to 85 billion dollars because I'm multiplying that number by about 30. And right now, the stock is being priced higher than that at 120 billion. So this one's a little too expensive. I think a lot of the gains are already priced into the stock. And if they have a further slowing of the revenue growth rate, this one's going to correct, and it's going to be a tough deal for anybody holding the stock because it'll come down. It'll come down to, I don't know, it'll come down 30, 40% because their revenue is just going to continue to, the growth rate's going to continue to get smaller and be less impressive. And at the current stock price, it's probably being priced where investors are like, oh man, it's such a great company. It's going to keep growing at 50%. And they're not paying it close enough attention. Analysts think their earnings per share is going to grow nicely, and that's where they get most of their valuation. But they're using an incredibly high PE. And if you look at, you can get 20% growth rate in companies with a lower PE. I can quickly show you Alibaba as an example. Well, Alibaba is not a good example because they're in China and Arista's in the US. So let's go to Microsoft, the biggest tech company, or one of the biggest tech companies out there. So Microsoft has a 37 PE, and they're a massive company, and they're growing at the same rate as Arista. And Microsoft by name is 100 times more recognizable, 100 times more comfortable for investors. So why is Arista being priced more expensively than Microsoft based on PE? We look at the PE of Microsoft. We're going to see that the PE for Microsoft, they're actually pricing it in the mid 20s 2 years out. But our friends at Arista are in the mid 30s a couple years out. And again, this is Arista. This is a lesser known company with probably less predictability. Microsoft, very predictable. We know what they do. We've known what they've done for 40 years. They're an exceptional company. I don't know if anybody's going to argue with me. Arista, I don't know. These guys could be worth half as much in 5 years. They could be worth more, but it's less of a known commodity or factor. So this one here is a pass. It's a really expensive stock, and it really participates. I think some investors are excited about it, and they should be. This is a growth company. But I really, to be a growth company, you got to keep growing. And I'm beginning to see that slowdown. That would be my biggest concern is, at what point do you lose the adjective as a growth company because you're not growing all that fast? You're growing just like most other, tech companies, and growing at the rate of inflation. So that's Arista Networks. Interesting that they've done so well over the last 5 years. And over the 1 year, look at that, 105%, so 104%. So I think a lot of the gains are already priced into the stock, and we'll see where that goes. So that's Arista. All right, so Mike's got good comments. FedEx is not union, understood. Cool. And then Tomas, how you doing, man? Good to see you. Yeah, let's look at Rio. And then Nitchix wants to look at TMUS. I've got that on the list. It's listed here. But we're going to take a look at Rio first, and then we'll look at TMUS. So Rio is a materials company, materials mining, that kind of thing. They explore, mine, and process mineral resources worldwide. They do iron ore, aluminum, copper, and these things are the materials that go into making aluminum, that goes into airplanes and a bunch of products, especially tech products. And we have iron that goes into steel and construction, steel that goes into cars and that kind of thing. Copper is used for electronics, electrical circuits, all kinds of stuff, and very, very valuable commodity. Now, Rio, I believe they are, where are they? I forget where they're located. So Australia, I forget where they're headquartered. I want to. So they are, United Kingdom is their headquarters. I was forgetting where they were headquartered. So they are owned by I guess a British company, but their mines and their operations are around the world. It's where the minerals are. So, okay, good to know. So we know that they're a miner, and they're, looking for the materials that are going to go into steel and all kinds of stuff. And this is the one. Over the last 5 years, you could see that the stock really offers points when you can buy, and you have these short-term rallies. Now, this is an industry where getting in and getting out, it's very important that you have a good sense or a good plan. This is where I want to buy. I want to invest at this level, and this is when I want to leave. You don't want to stay at this party too long, because you can see that as the economy goes up and down, it's going to really affect these miners and these material companies. So in the case of Rio, you've seen that happen. Now, it's not a super impressive 5-year return. So again, it's not a stock that I would consider buying and staying for a super long time. Let's say a Meta. But it is a stock where if you buy it at the right times, you can really see your investment appreciate. Right now, we're seeing that over the last year, there's been a couple of times where you could have really performed a swing trade, got in, got out, made some money, and moved on. So I think that's going to be a key requirement in the plan around a company like Rio or any other. Now let's take a look at their fundamentals. All right, so it's a $110 billion market cap. This is a well-known company. Revenues of $54 billion, nice and profitable, even with commodity prices not really enjoying great, commodity prices just yet. The company's still really profitable. It pays a nice dividend at 6.67%. It's a buy rating from analysts, so that looks good. So if you're looking for income, not a bad place to look. They are growing a bit over the last trailing 12 months. In the UK, they issue out financials twice a year, semi-annual, versus in the US, we go 4 times a year. And the first half of 2024 looks pretty good. Grew slightly. And then the second half of 2023, they grew nicely. They did have kind of a lull in their business. Looking at, for about a year and a half, they had negative growth. Okay, so interesting. The business may be on the rise. They had a couple, a year and a half of slow sales, and now it looks like they're beginning to really pick up sales. One thing, a homework item, if you're interested in Rio, is you look at their financials and look at their volumes. Are their volumes growing? Because a company can't control the commodity markets, but they certainly can show that they're efficiently run, that they have good volumes being produced at their companies. So this is looking pretty good to me. And net income looked good. Free cash flow looks really good at 3 billion. This is I still have it in halves. So let me get back to the annual so I can see the full year. So full year free cash flow, 7.1 billion. Now, these companies are not valued like a tech company. We just saw Arista with a PE of 48. This one has a PE of 10, which is realistic. So if I take that free cash flow that was roughly 7.5 billion, I get to like $75 billion of value. I think it's doable if you are comfortable that, hey, you're going to be buying in at the right time and kind of seeing a good rise. Right now, it doesn't look like a bad time to buy into the stock. I mean, it's priced nicely. I might even watch this stock and wait for it to drop a little. It's dropping today. And maybe pick it up like at, sub $60 a share. Maybe pick it up at $55 a share. And then, accumulate. I like to dollar cost average my investment. I'm not good enough to know exactly that, hey, on this date is when you ought to buy $30,000 of Rio. I'm not that good. I sense that there's certain periods of time, like this period would have been a really good time to accumulate some shares. And then at a certain point, it just starts to rally and just watch the stock rise. So those are my comments generally about Rio. Is it seems like a good place to be thinking about. Really get familiar with Rio. They have BHP as a competitor, or I'm going to just say a comparable company. I don't think they compete against each other. Not like Ford and GM or Coke or Pepsi. TX is similar and different. TX probably does more of the processing of the steel and actually delivers a rolled steel to their market. But TX does have mines, and they do have a more integrated business. And I like their geographic location just south of the border of the U.S. for 60 plus of their operations. So I like the space right now. I think it's a good space to be doing your homework around. That is, mining and materials. It's not a bad time. I think stock prices are reasonable. They might even get a little better. We're dealing with a market that's really done well this year and last year. So pretty good idea. I like the idea. I think we should continue to talk about materials and mining. Just keep beating up the space so we can find some good companies to sink our teeth into, potentially find good companies that could be considered as an investment. So thanks for asking about Rio. I like it. I like the theme. I'm going to keep looking at it. I'm going to probably do a little homework beyond what we just talked about on Rio. And I'm going to add BHP. I owned BHP a number of years ago, got in, got out, made money, liked the company. And I think right now is a good time. This is one of those stocks where what's going to happen a year from now? What's going to happen 2 years from now? I would not be surprised if a year or two from now, commodity prices have gone up. Rio is sitting on higher profits. They're sitting on higher free cash flow. Their stock price is trading at $80 a share. And, 2 years from now, I'm like, okay, I'm going to get out. I achieved a good rate of return, and I'm going to go ahead and cash in my investment. Knowing that, I would probably buy Rio. I have a couple of accounts, and one of them is fully taxable. So I wouldn't buy it in that one. I'd probably buy it in a non-taxable account where I buy, sell, and there's no taxable event because it's all money that's pre-tax. And I will be taxed on it when I pull it, but immediately I won't. So I'd probably buy it in that portfolio because I aim to get in and get out and probably make a return, whether it be 3 months or 18 months. I'd probably get in and out. So good stock to talk about. Very good idea to be thinking down the road. Thanks for bringing it up. I appreciate it. Let's move on to TMUS. Knit Chicks, how are you, sir? And TMUS. T-Mobile. All right, let's talk about T-Mobile. Before we jump into T-Mobile, let me just take a peek at the market, see what is going on. So this isn't right. We're not going to go up another 2.5. Here we go. So the markets are pulling back slightly. They're flat. No big deal. We're down a little bit on the NASDAQ. This can't be right. The Russell's up 2.2%. Come on, Google. You got to buy better servers and give me better data. If this is right, then it's a little cause for celebration if you own small caps. S&P, okay, this is flat. It's expected. I mean, we had a phenomenal day yesterday. Can't expect that to happen every day. If it happened every day, holy smokes, we would all be gazillionaires by the end of the week. All right, so that's where the markets are at. Wonder what crypto is doing. So Bitcoin is down a little bit. It was a little above 63,000 when I looked at it earlier, and it's kind of given up some of those gains. All right, back to T-Mobile. So T-Mobile is most definitely in the communication services space where they're very well known for their mobile phone service, and they're very well known for growing their company. They've grown really nicely, grown far better than AT&T or Verizon. Now, on the surface, I think this is a really attractive space because it's a very sustainable, consistent business where people are going to need their phones. They're going to need internet. They're going to need communication services. So high level, attractive. But as we get into it, one of the things that I dislike about this industry is their debt levels. I haven't seen T-Mobile in a while, but let's take a look, and I'll glance at AT&T and Verizon because I'm pretty sure AT&T and Verizon are going to have too much debt based on my recollection. So T-Mobile is a pretty high market cap company, $232 billion. The revenue is $79 billion. Net income, pretty good at $9.46 billion. P ratio of 25, forward PE of 19.5. They have a 1.77% dividend. Over the past year, it's up 40%. Very nice. 151% over the last 5 years. T-Mobile has really been exciting. Within the space, it's been the most exciting stock. When we look at revenue growth, it's been a stock that's been going up and to the right. And I'm like, holy smokes. Why is it going up and to the right? There's no growth. The up and to the right, they should be going up like that if they're growing, right? That deserves to go up and to the right. But for the last 2.5 years, no growth. Huh, interesting. So they might be kind of not resting on their laurels, but maybe the stock price is really benefiting from its historic growth. And people still think of it as, hey, it's a growth company. But the revenue on their income statements, really tells a different story. That they're not growing. Okay, they're not growing. So when we look at balance sheet, that's really where the rubber hits the road for me on these companies. $6.4 billion in cash and short-term investments. Total debt, $115 billion of debt. Woohoo! Holy smokes. What's their EBITDA? So their EBITDA is 29 billion. So they are not too bad, but they're probably at a 3.3, 3.4, debt to EBITDA, which is higher than I'd like. I want debt to EBITDA to be less than 3, which really represents a company's ability to pay off all their debt using their earnings before interest, taxes, and depreciation in less than 3 years. It's basically a ratio that shows a balance sheet that's healthy. And these guys have an unhealthy balance sheet, not super unhealthy, but unhealthy. Because when you take, let's call it 30 billion, and you divide it into 115 billion, we get to almost 4, like 3.75. That's a lot of debt. And this is a lot of debt. When you look at debt of 115 billion and the market cap is 232 billion, it's like, holy smokes. If you just kind of putting it in simple terms, if you wanted to buy this business, you would write a check for $232 billion. And then you'd have to write another check for $114 billion to the creditors. So you'd have to pay $350 billion for this company. So that's why I pass on this industry, their balance sheets. I could find other businesses. These guys aren't growing, and their balance sheet, I just shared my reservations there, and that's a deal breaker for me. Balance sheet's bad, I'm out. I get to pick from thousands of stocks, thousands of them. There's no rule that says, Victor, you have to buy a communications company that looks like T-Mobile or looks like AT&T or looks like Verizon. I want to go here. I want my cake and I want to eat it too. I want a company that grows like Microsoft and produces free cash flow and really generates tremendous value, has a space where they continue to expand. Their industry is expanding, and they have barriers to keep their competitors out of their marketplace. Either these barriers were earned, like Google search is number one, just beat everybody fair and square. And they have great competitive barriers because advertisers want to use Google search. And those companies operate in a very prosperous space. And I want a discount because I'm not going to overpay for a stock. I don't care how cool and exciting you are. I'm going to get a discount because I have thousands of stocks to pick from. And I want to find companies that are misunderstood, that have great moats, great barriers of entry, great cash flow production. And it could be that they had a bad year, maybe a couple bad 18 months. Meta in 2022, they invested in the metaverse. Investors didn't like it. The market didn't like it. They beat up on Meta, discounted the heck out of that company, became such an opportunity. Boom. And then now everybody realizes Meta is such a valuable company. They generate so much free cash flow. They keep expanding their marketplace. So why buy a company that I think is got a bad balance sheet, no growth? It's an industry that just isn't a very prosperous industry, in my opinion. I'd rather move on and go find the next Meta, the next Google, the next Microsoft. Where's the next one? Maybe it's in small caps. Maybe it's somewhere hidden and investors aren't looking at it. So instead, I'll keep my cash and my capital in cash or, something creating a yield and keep looking for the next Meta. So that's where I'm at with T-Mobile. Thank you for asking. I hope you found my comments interesting and would love to hear what you have to think, what you think of T-Mobile. T-Mobile is kind of a rock star stock. Their CEO is pretty cool, pretty interesting. And Jim Cramer loves T-Mobile. Jim Cramer, I think he's fun to watch. And there is some things that I glean some value from Jim Cramer. But at times, he has too tight of a relationship with a CEO and a company. It really pumps up that company. and it really removes, I think, uh, uh, a realistic kind of opinion on a company. And T-Mobile is probably in that category of companies that Jim Cramer loves. And that's all I'll say about that. All right. So if there's no other suggestions, I want to talk about Airbnb. It did nice. It had a nice rate of appreciation yesterday, and it's keeping the party going. We are renting out an appreciating price for one more night with Airbnb. I love this company. I love their innovation. They are, in 5 years, it's appreciated 91.9%. But over the past year, the market said, we're really scared about the travel space slowing down. There's good reasons to feel that way. I think the travel space was really doing great. And I like using Google for this type of review because I get to use their technology and kind of prove a point. As people started to travel, like because we were so cooped up because of COVID, this stock was really working. Now, this is a long-term hold for me. I'm not selling Airbnb. I think Airbnb is going to be worth twice as much, if not 4 times as much in 5 years, because they're a disruptor. They have a marketplace that continues to expand. They are trying, what they do is they go and they rent out privately owned residences or rooms, and they rent them out to travelers. And it really has changed the way travelers are traveling. I've been to Europe, stayed in Airbnbs, Mexico, Airbnbs, all over the United States, Airbnbs, Canada, Airbnbs. And it's just a great experience. When I travel with my family, we don't stay in hotels. Hotels really separate us, and the heck with that. I'd rather be in a house where I'm just hanging out with my kids, hanging out with my wife. It's great. And they usually put you in a really nice place within the city, where hotels put you in the hotel district. And it's all very commercial. I'd rather stay in a cool little neighborhood in whatever city I'm traveling to. Now, the addressable market is massive because you think about, well, private residences, that's massive around the world. Airbnb is growing very fast internationally. The Olympics are going to be priced into the current quarter that we're operating in. And they told investors before that you saw this really big drop, they said, hey, guys and gals, we're going to have a weaker Q2. They still grew, but we're going to have a weaker Q2. But Q3 is going to be phenomenal because of the Paris Olympics, the Olympics being in France. And they told that, and they housed more than 400,000 people during the Olympics. So Airbnb, over the last month, it's working. It's beginning to work. It's taken off nicely. I think the lower interest rates really support growth companies. Speaking of which, okay, so these guys are an $82 billion company. These guys didn't exist, call it 15 years ago. They started about 15 years ago, and they're a $10 billion company. Let's take a look at their growth. Their growth is slowing down. They're a $10 billion company. Remember, Arista was 6, and they're growing the same rate. Airbnb is bigger, and they're growing at 15. Now, the quarterly, this is where they said, hey, our Q2 is going to be light. But our Q2 is going to be light. Our Q3 is going to be great. So the market's kind of interesting. Sometimes it's irrational, and sometimes it's a little dumb. It's like the company tells you like it's going to be a light quarter and then a good quarter. The company forgets it. The stock market has a very short memory. It forgot that, hey, Q3 is supposed to be really good. So I'm expecting Q3 is going to be phenomenal for Airbnb. It's good to see the stock begin to take off because I think if they have a very good earnings for Q3, which will be announced, I'm going to guesstimate in about a month. See, Q3 is going to end at the end of September, and then they'll announce in late October. So, and in fact, it's right here, October 30th. Okay. So I believe in Airbnb's business. When we look at the desirability of a company, why do I like Airbnb? Well, Airbnb is creating their own little industry, right? They're not a hotel. Hotels, we know what hotels are about. Hotels are REITs. Hotels are, you invest in a big, expensive commercial property and you rent it out to people that want to stay there for the night. Totally get it. Lots of competition. Really, it's a very well-known industry. Airbnb is like, the heck with that. We're like Uber. We're going to, whether you want to stay in a one room, you rent one room within a dwelling, or you want to rent a 4-bedroom house. It's all there. You want to rent a palace or a big, beautiful home for a special occasion, let's say a wedding. All those things are there. And it's really been a high growth area for them. And I think they're going to continue to grow because their addressable market's so massive. Their international expansion is so big. They're going to be like Netflix. They're going to be like Uber, expanding globally with their network. And they have the best experience for the traveler, especially in the US. And the US travelers have a lot of discretionary income. So I think that they are clearly in the green for me. So I like Airbnb for this reason and continue to really like the stock. I own about $100,000 of Airbnb and will be holding that investment. I'm not buying more shares just because I don't want to get too into a smaller stock. Like I own more than twice as much of Meta as Airbnb, almost twice as much of Google Alphabet. Those are bigger, more established companies. So that's Airbnb. It's good to see that they're continuing their rally. Very good to see. I think the stock, if I owned less Airbnb, I would have been buying up more shares, but I own a little too much of it. I wouldn't say too much of it. I just own enough, I should say. So when we look at Airbnb, where is that stock? Here it is. So I own $101,000 of it. It's a newer company, and from that respect, a little riskier because they don't have a fully mature business. Whereas, Meta, I know what I'm dealing with Meta, so I'm willing to invest more there. So that's where I'm at with my Airbnb stock. Good to see that it's really working well. Somebody in comments on one of the videos wanted to look at Airbnb, and I wanted to cover it. So, all right. So, Mr. 123 Cheetah, T-Mobile has done 3x for me. Congratulations. Awesome. And most definitely, it's been a stock that's really worked. And I hope it keeps going up for you. Android PC, NVO is going down today. NVO. So NVO, Novo Nordisk. Novo Nordisk is a pharmaceutical company. So these guys are trying to compete for the weight loss drugs, right? The obesity drugs. They're a big market cap, 594 billion. What's causing this pullback? I'm not seeing the negative news. So very high market cap. These guys and Eli Lilly have been doing great. And over the 5-year, very good chart. Doing great. Now, revenue is 37 billion. So you're paying like 16, 18 times revenue for the company. This is a big company. And the PE is 46, 34. Forward PE. Their growth rate, that's why it's so valuable. Look at this growth rate. And it's a big company. This is in DKK. Where are these guys headquartered? Denmark. Okay, cool. So their growth is really impressive. Wow, really impressive. And it's that new weight loss drug that, is all the craze. And they and Eli Lilly are really, really doing well. Their cash flow, 81 in DKK to US currency. Let me do that over here. So that's the Danish krone, and it's 0.15. So 81. 81,155. That would be $12.1 billion of free cash flow. And their market cap, hopefully that's in dollars. Yeah, it has to be in dollars. Okay. Yeah, so 12. I mean, it's really hard to value these companies because, I mean, I'm thinking the company's worth 360, 400 billion based on free cash flows, and it's close to 600 billion. The growth rate's really exciting investors. That's great. I mean, if they keep growing at this clip, I totally get that it's really worth that much. But if it starts to slow down, it's going to be a haircut for investors. It's an impressive company. If you really believe that they're going to just keep accelerating their growth and keep growing at that clip, I totally get it. And their dividend is not very high because the stock price has been going up so much. Balance sheet, they have 62.6 Danish krones, which is roughly, so that's roughly about 9 billion, 10 billion in US dollars. And then total debt. Here it is. See how these guys, we looked at T-Mobile, right? They were almost half their market cap was debt. These guys, only like 10% of their market cap's debt. It's 57 Danish krones, and actually lower than that. It's going to be more like $9 billion of debt compared to their market cap's almost 600 billion. So these guys they could pay off all their debt immediately. That's a sign of a really strong, valuable business. We generate so much cash, we don't need to have debt. It's like paying off your credit card every month. I don't want to carry a balance. So just get that off the balance sheet so we don't have to pay any interest at all. So this one here is not, I'm in Pfizer. I'm invested in Pfizer because I think Pfizer is going to be a stock that's misunderstood and it's going to start to work. And they have really built out their business. During the COVID years, they had a COVID vaccine. They did great. It was not a sustainable business because we got over COVID. They used all that cash to really expand their business, and they have expanded. The revenues are growing. And I think that right now it's misunderstood. So I've been buying into Pfizer and think that over time it's going to do well. So on the income statement, they're beginning to grow. And that was their big hang up, was during the COVID years, their revenues exploded, right? They went from 41 billion to 100 billion because there was COVID vaccines. But they weren't going to sell COVID vaccines forever. But they're still at a higher run rate than before COVID. You see that. And now they're beginning to grow. If you look at the quarterly, if you compare that quarter to the year prior. So that's where I'm putting my capital, is I'm putting it into Pfizer's, because I think in a year or 2 years, it's going to be worth a lot more. But I totally get Novo Nordisk is really valuable. They've done a lot of good things right. It's just not the right investment for me. I recognize they're a valuable company, but in my mind, they're priced at a premium. And I don't know that they're going to, it's priced for perfection. It's priced for only good news. If they have a couple bad events, or if they stop growing as fast as they are growing, I think the stock price is going to come down. So thanks for asking. It's a really interesting company. And Novo, as well as Eli Lilly, man, they've done so well. So impressive. All right. So yeah, I just talked about Lilly. Eli Lilly's right there with these guys. Lilly's just been, I think that's close to being $1 trillion company. Yeah. $842 billion. It's up 2%. The last month it's down a little bit, but mean, you look at 715% rate of return. And this is I believe it's a British company. They are firing on all 8 cylinders. They have the weight loss drug. They have other drugs that are doing really well. The PE is super high, $115 million. When you get a story like weight loss, right? Everybody can get their heads around that. Oh, weight loss, it's going to be so beneficial, right? And people can be healthier if they can lose weight. Totally get it. It's really going to help with a lot of diseases, and that's great. But I think it tends to probably artificially inflate the stock price because everybody gets it. Everybody wants to be in it. And that's not the lane I'm in. The lane I'm in is I got to understand what makes the business valuable. Do I believe in the expanding, marketplace? Do I believe they're the dominant player? Most definitely Eli Lilly, like a couple of years ago, was definitely that. And I missed it, frankly. I missed on Eli Lilly. But I think these investments are kind of hard for me to make. I would pass on them because I think the best case scenario is priced into the stock. If anything veers from the best case scenario, you're going to take a haircut. You're going to see your investment go down in value. And but good luck. I hope the investors keep making good money on this. And most definitely, if you invested in Eli Lilly 5 years ago, congratulations. You made a ton of money. What's up, Brad? Good to see you. Good morning. Take a look at RPRX. Let's take a look at RPRX. Royalty Pharma. Royalty Pharma operates as a buyer of biopharmaceutical royalties and funder of innovations in the biopharmaceutical industry in the United States. It's also involved in the identification, evaluation, acquisition of royalties in various pharmaceutical therapies. Okay. So they're like buying, I guess they're buying the patents and then trying to license the patents and receive the benefit of, hey, if you license the patent, you can manufacture that drug, but you have to pay us the royalty, which could be quite profitable, quite lucrative. Very small cap, 12.4 billion. Stock's been really, really going down. Well, down 1%. This chart looks like it's gone down more than 1%. So that is down 1% today. Over the 5 year, it's down 43%. It's been sold off. Okay. $2.2 billion revenue company. Market cap is 6x. PE is 18. Forward P is 6. They pay a dividend. So it looks like their revenues are declining. They had a bad quarter, first quarter of 24, but they kind of recovered. In second quarter, it looks pretty decent. Now, if they're just dealing with the management of patents and so forth, it's almost like a financial services company. They bought into a patent and then are trying to extract as much value from that investment as much as they can. Their free cash flow is really impressive at $658 million. It's been consistent. Look at that consistent cash flow. Now 600. So that's a lot of cash flow. So if we look at 658 divided by so that would be about 5% free cash flow yield. So this one here, I'd want to get an understanding of like their growth rate. They're kind of flat. And is the market expecting that, hey, they have a lot of patents that are going to expire and therefore they're going to lose that revenue. is that going on? There's like homework to be done on royalty. That's where I'd have to get my head around that. And, they probably provide it on their investor page. They probably provide like a sense of what patents they own and when they're going to expire, because I think that's going to tell us, are these guys going to have growing or consistent revenues for the next 5 years, or is there going to be a drop in revenues like in a year or two? And that's what investors are pricing into the stock. So I would say you got to look at their financials and look at their annual reports and see what they're putting there, so that we can have a sense of, when are these patents going to expire? So, okay. And it may not have it in the quarterly. It's probably going to have it in the annual report, where they give you a complete, overview of their patents and their royalties and so forth. Yeah, this company resembles to me like more of a financial services, kind of like an investment company that they buy these investments and then they license them. So they do a good job of saying, hey, we have all these patents and all these companies are doing that, but I'd want to see here we go. Nope, that's not it. So yeah, the homework is get to know their patents and know what the forecast is on those patents, when they're going to go off patent and therefore expire and then not have a lot of value. And that's going to result in a lowering of revenue. If you see that, hey, the market's got it wrong, it's a good opportunity. If the market's got it right, then okay, so this is going to be a declining revenue company, not a lot of enthusiasm around it. That's potentially what's going on. Interesting company. It's not exactly a pharma company. It's more of like an asset management company within pharmaceutical, which is cool. Thanks for asking. All right, we're going to go another 5-10 minutes. And let's see here. I think there was a question. So it looks like thoughts on Google and Spotify. Okay. So we covered Spotify Tuesday and went into it quite, we took a deep dive into it. The conclusion was that I thought it was priced a little too high. The reason for it is the revenue is good, but it's not great. So when we look at their total revenue is 14, this is euro, close to 1-to-1 with the dollar. So we'll just go with it. It's about $14 billion billion in revenue. And they don't, I think the cash flow, when we look at cash flow rate is 1.3 billion. And they are a growth company. So I could probably get to like 26, maybe 35 billion in market cap. And it's priced way higher than that. Like the free cash flow rate's not very high. Whereas Google is a different animal. It generates incredibly high cash flow. When you look at cash flow here, you're like $60.7 billion. Wow. That's a lot of cash flow. And they keep growing their revenue. Look at that. They're so big. Google Alphabet is $328 billion in revenue, and they're growing at 13%. It's so mind-boggling that they can grow. They grow each year like the size of a big company, $30 billion company. That's what they grow each year. Nuts. And they have a market cap of $2 trillion. Now, how do I get from 60 to, if you take 60 times 30, you get to like 1.8 billion. So you could say, hey, this is kind of fairly priced, but you're in the ballpark. Where Spotify, you're not in the ballpark. I'm getting to like tops 40 billion and they're priced at 73 billion. So it's hard to get there through cash flow. I'm a big Spotify fan. I'm a customer, been a customer for a while, enjoy their service, a couple of times a week, especially on weekends. And I like how they put books on there, by the way. I really enjoy that. But they just don't seem like the right investment for me. The other thing that I dislike about Spot is I think they're a one-trick pony. And if guys or companies, big companies like Google or Apple, and Apple is trying to replace Spotify through Apple Music, Microsoft, Amazon Music's out there. At what point are consumers going to pivot to, hey, I'll just use my Google service, or I'll just use my Amazon service? I'm not ready to let go of my Spotify, but I could see myself letting go of it if I stop using it as often. So they might have a growth problem in the future. They're a one-trick pony. It's very hard to expand outside that kind of little micro industry that they're in. And I think they could be vulnerable to the big giant companies. And the big giant companies, I mean, Google could buy this business. They could, again, they're growing by more than $30 billion in revenue growth per year. They grow more than 2 times the total size of Spotify each year. So if they really wanted music, they could totally attack Spotify and take some of their business away. So that's where I arrived on Spotify, and a quick glance at Google. I own Google. It's a good investment. I think they have a great future. They have AI in their future, which should be interesting, but their current businesses are just phenomenal. Search, YouTube, their Google Cloud business, just a phenomenal company. That's why they're worth $2 trillion. And I'm not buying any more shares. I've got enough shares for now, and I'm going to probably wait a couple months to see what the heck this market's going to do. It keeps surprising me, and I'm okay with it surprising me to the upside. If it keeps driving my stock prices up, I'm not going to complain. But I am feeling like stock prices are a little expensive. The NASDAQ is down a little bit. For the 1 year, it's up 33%. Woo-hoo. Very nice year. Very nice year. The last 5 years, ever since the end of 22, we are up and to the right, 71%. But let us not forget, things don't go up forever. Just 3 years ago, we started a pretty nice correction on the NASDAQ of 35%. So just be aware. At some point, we're going to see another trend like this. Not sure if it's going to happen soon or in a year or in 2 years, but it's going to happen. And we'll see when it happens. All right. So it's been a good session. It's been an excellent week. Thanks so much for showing up. Looks like, Mike, you've got a request on PEP. I got to move on. I've got to get to some things I've got to do this morning. So I'm going to put PEP on tomorrow's list. And just remind you of something I want to keep asking myself, and I'm actually going to go through my portfolio and kind of ask myself that question on each one of my holdings as well as my watch list is, how is this stock going to work in a year or 2 years? Is this a stock that's going to have a good trend over the next 2 years? And just answer that question. It may be a stock that I just want to hold for a long time, like Airbnb. But if it's stock that's a little more cyclical, it's good to understand that. Good to put some homework into it. Maybe I want to put some more capital into it. Maybe I want to take some capital out. I'm going to keep asking myself that question about my portfolio. And as we talk about stocks, I'm going to keep asking that question: is how is this stock going to do over the next, year or 2 years? And with that, everybody, enjoy your Friday. Have a nice weekend. I will not live stream tomorrow at 6 a.m. or Sunday at 6 a.m. You enjoy the weekend. I'll be back on Monday, 6 a.m. Pacific, 9 a.m. Eastern. We'll see how the market behaves today. It looks like it's going to be a little bit of a down day, understandably. We had a really, really good day yesterday. We have to give back some of the gains. That's understandable. We'll just pick up on Monday and see what the market has in store for us. I don't see any big news next week. I don't know that we have big news like this week, right? We had the Fed making their announcement on Wednesday. We had an employment report yesterday. We'll see how next week goes. We'll just have to worry about the election now. So, everybody, thanks for tuning in. Really appreciate it. Good luck with your investments. Take care.